Let's welcome Rajeev De Mello, Head of Asian Fixed Income at Schroder Investment Management, which oversees $300 billion of assets globally. Thanks indeed for coming in through this typhoon as well, Rajeev, for coming in today.
Well, thank you for having me. It's good to be here.
Now, your experience is pretty vast. Again, back in the 90s, you were head of the bond trading desk in Europe at UBS, and also Asia bond trading desk at UBS in Hong Kong. So you've been right in the heart of it, haven't you? What is the atmosphere amongst bond traders right now to deal with this European and the US debt crisis?
Well, the atmosphere is obviously one of stress. I mean, we saw we watch all the markets around, and there's an incredible flight to quality, flight to safety, to government bonds. So government bonds worldwide are doing well, except for the countries which are really affected by the European crisis. And that applies to Asian bonds as well, which have done well over the last couple of months. So nobody wants to lose any duration government bonds. And that's really stressing when you think that U.S. Treasury yields are so low, and so are Hong Kong yields and most of the region as well.
You manage the Schroder Asian Bond Absolute Return to $1.14 billion. There has been, it would seem, an outflowing of funds back to the U.S. Treasury. Is there a much better value, do you think, in Asia, for example, the Korean bond, which is your biggest holding?
Yes, I do think that there's a lot of value in Asian bonds.
Lots of value?
Well, when you look at the fundamentals of Asian countries, they're remarkably good. They were remarkably good going in the last crisis, in the global financial crisis, and they're remarkably good right now with low deficits and low total debt to GDP ratios, something that a lot of investors are looking for when they're trying to invest in a bond.
Now, you actually launched this fund October 2008, which is incredible timing after Lehman's, and it's risen about 161% since then. Everyone's discussing Lehman. This is obviously being seen as perhaps a lot worse. It's sovereign debt, but it's also a banking crisis, isn't it? Now, going back to when you launched it, that must be quite an experience to launch a fund a month after. How do you position yourself now with what is happening?
Well, the crisis trades in bonds is obviously to be long bonds, especially in the government sector. The corporate sector, as you mentioned, is stressed. There are, of course, there's incredible value when you have an event like this. Corporate spreads go quickly and price unrealistic expectations of default over the next 5 years, levels which we haven't seen over the last 20, 30 years. And especially in a region like Asia, where even if there's going to be a slowdown, because Asia is not immune from the global environment, it is quite unlikely to actually go and reach the default levels which are priced into the bond market right now. And so that's what gives value to the corporate sector as well.
Overall, though, I just want to ask you that the U.S. Treasury reaction below 3% again. Do you think it's an overreaction, or do you think it's a realistic view of the global scenario?
Well, there are two effects on
the 10-year.
Yeah, there are two effects really on the U.S. Treasury. One is, of course, the flight to safety which is going on, and the other one is Operation Twist announced. So we know that that the U.S. is going to come in and buy Treasuries. So that, of course, makes the long end of the yield curve rally, and yields come off sharply. So overreaction, I don't think so. There is really a scarcity of safe haven bonds. And U.S. Treasury bonds are perceived as being safe haven, and especially in an environment where Europe is under considerable stress right now. So that offsets completely the budget problems that we had in the U.S. in early August.
You sort of caveat your holdings with subject to rate, credit, and default risk. You just talked about the scarcity of safe havens. Let's discuss this Asia story again. You mentioned before there are a couple of areas of safe havens. What is the safest haven, and what is to hate this expression, but the best risk to take?
Yeah, I mean, there are two ways of looking. The traditional safe havens are U.S. Treasuries.
Yeah,
that's the typical one. Of course, in the meantime, in the last 10, 15 years, we've seen a deterioration of the fundamentals around U.S. Treasuries, notably higher deficits and higher total debt. Now expecting that to get worse over the next couple of years. So if you look at countries where the fundamentals are still very good, you have countries in Asia which really stand out, like Singapore, for example. Hong Kong also has a great position, and many of the other countries in the region. So that's the way I would look at safe haven, more on the fundamental perspective. But when we look at price action over the last month, actually Hong Kong and Singapore bonds, Chinese bonds have done well. U.S. Treasuries have done well, but some of these more developed Asian markets have actually kept pace.
Final question for you, Rajeev. Absolute return fund, where have you been reallocating, if at all, your assets, or increasing holdings?
in bonds, in government
Asia,
bonds,
yeah.
in Asia. There, as I just mentioned, I think that there is still potential. Right now, central banks have been on hold in Asia. They've been tightening in the first half of the year, and in response to higher inflation. And now with this shock going on, they're not very sure whether they should start loosening policy or whether they should stay on hold. So the easiest choice is to stay on hold and watch. If the situation gets worse, I think they will start cutting, and we saw that in 2008, and that would give the bonds in this region quite an impetus on the upside.
Rajeev De Mello, many thanks for joining us there.
Thank
who
you.
runs the Absolute Return Fund at Schroder.